Hello, my name is Ray Franklin. I'm a Senior Commodity Analyst for Energy Professionals. In today's video, I'm going to be discussing my May 22nd Energy Update. But before discussing that report, I want to give you a brief summary of my May 10th Energy Update. The May 10th Energy Update pointed out in their latest short-term energy outlook, the EIA has forecasted natural gas will average $3.49 per million BTU in the fourth quarter, which would be a 54% increase above the previous day's close of $2.27. And the average price for 2024, they're forecasting will be $3.72, which would be a 64% increase above the previous day's close. The EIA believes the average price of natural gas and electricity will be higher in the fourth quarter of 2023 and throughout 2024. But what led the EIA to this conclusion? In our April 17th Energy Update, we pointed out natural gas tends to be lower in the spring and fall between the winter heating and summer cooling seasons. And this pattern is especially accurate when the spring or fall lows occur near historically low prices. For example, since 2000, natural gas has declined to near today's unsustainably low prices 4 times, and in each case, the final lows were attained either in the spring or fall. But why were prices that low unsustainable? They were unsustainable because they were below the cost of production, and companies were no longer profitable near those low prices. Therefore, the weaker companies didn't survive, and those who did survive were highly motivated to decrease production so they could recoup lost revenue by raising prices. The question is there any indication energy and exploration companies are starting to decrease production that will lead to higher prices? The answer is absolutely yes. The May 12th Baker Hughes weekly rig count reported energy companies reduced the number of gas drilling rigs from 157 to 141 rigs. This is the largest reduction since February 2016. And it's important to understand the gas rig count is an early indicator of future output. And this report confirms energy companies are beginning to decrease production. The recent decline in gas rigs was the largest since February 2016. The question is, how did natural gas respond to the sharp decline in gas rig drilling in 2016? In 2016, after the sharp decline in gas drilling rigs, natural gas reached the spring shoulder low the following month, and the price of natural gas moved higher into the fourth quarter with no significant pullbacks. How has natural gas responded this year after the EIA's May 9th short-term energy outlook forecasted much higher prices by the fourth quarter, and the Baker Hughes report on May 12th showed the rig count was declining sharply? It should be no surprise that natural gas has rallied after the May 9th EIA short-term energy outlook forecasted higher prices by the fourth quarter, and Baker Hughes reported the largest decline in gas rigs since February 2016. Based on this empirical evidence and the fact that in 2012, 2016, and 2020, when natural gas prices in the spring were as low as they were this spring, their prices were always much higher by the fourth quarter. And it is highly likely prices this year will also be higher by the fourth quarter. Hopefully the empirical evidence in this chart helps you understand history is repeating itself, and natural gas and electricity prices will likely be heading higher into the end of this year and throughout 2024 from present levels. Therefore, if you have an agreement expiring within the next 18 months, we recommend you don't delay hoping for lower prices and reserve power now to be available when your present agreement expires. The upside risk is too great to justify waiting, hoping for slightly lower prices. And hopefully this video helps you appreciate why this is so. And until my next video, please take care.